Good morning, Chris. How are you?
Good morning, sir. I'm fine. How are you?
I'm good. This is Brian Jones. I'm here with professional trader, world's most interesting man, Chris Hood. How are you doing this morning?
I'm excited, man. I've now been given approval that my age group can go and get a vaccine shot. So now the question is, what is this vaccine and is it good for me?
Yeah, well, you'll find out. I guess Yeah, I I don't know. Like, we have a pretty wide variety. We've got three of them that are approved here. Although they think the Johnson and Johnson one has been put on halt by our
Yeah,
the CDC because of some blood clot issues or something.
man, I don't know. I'm sitting here and I'm going, I wonder if I'm more concerned about getting a vaccine or watching Bitcoin or this dodgy coin, whatever they call it, joke meme suddenly get $50 billion worth of market cap. Do you know that Dodgy coin is worth more than Ford?
Yeah, I was. There's a lot of buzz around that. So, what do you? So, what do you think about the sort of crypto space right now, like short term and like long term?
I think long term things will be fine. I think
Mm.
if you look at what's happening with this Dodgy coin, whatever you want to call it, I can't even pronounce it properly. The thing was a joke. It was set up as a meme, and the fact that you've got this exuberance going into it and this valuation that just makes it look preposterous. I mean, everything ties into this Coinbase IPO. Like, you've got to remember, the market top will always be signaled by irrationality. So was the Coinbase IPO the top for Bitcoin? Probably. I think for the short term, I think there's a lot of technical damage that's been done to the charts. It's got a lot of work to do to get back up. We exited our Bitcoin positions already. Ethereum is probably where I think the best opportunity stays, because a lot of the new stuff in the crypto space is based on the Ethereum model. So and the Ethereum technology. So I would be going long Ethereum. I wouldn't be long Bitcoin. We got out of our Riot position. Canaan took a little bit of a whack because of the China affiliation and Bitcoin. Obviously, we exited our signature bank position as well, and we've still got Silvergate Capital. So we still have our our crypto aligned trades. Um, but I think it's ridiculous now. It's got to the point where if a joke meme can be worth more than a 100-year plus company with a proper business, you have to ask yourself whether this is just the top and things are going to come crashing down, or is this reality? Is this the new reality we have to deal with? I mean, I wouldn't put my money in it, you know, at
You
all.
need
I
you need
think,
some technical indicators how to trade joke memes.
yeah,
You need a new system.
yeah, I found a way to trade joking. I think there's going to be an adaptation period for all of us to understand the implication of what happened with GameStop.
Mhm.
Like, what happened there was a seismic shift. It wasn't necessarily an elimination of the power balance between institutional and retail, but it's going to take some time for us to sort of get a grip around what that actually means for us. Because if a joke meme can suddenly be worth $50 billion, look what happened with the NFTs a couple of weeks ago. Those non-fungible tokens. So those, I mean, some guys were selling their first tweet. The first tweet, they were selling it for millions. And I'm like, this is like, what is the actual value of these things that they're selling? Number one. And then all of a sudden, they were selling these art pieces, and there were huge numbers, lots of zeros. And then a week later, just crashed down. So I think for retail investors, stay as far away from this garbage as you can, because you will likely be the guy holding the lump of coal at the end. This is one thing that I find pretty scary about the advertising of how easy this is. The illusion of easy money is seductive. Everyone's looking for a quick way out of whatever problems they may have, and there isn't one. There just isn't one. If it was easy, everyone would do it. Everyone would be winning, and we would live in in a socialist / capitalist paradise with everyone the same, right? But the markets are designed in such a way to move money from one person's pocket to another. You just need to make sure that you're always the guy that's receiving and not giving. Now, it sounds
I didn't come into it with the idea that this would be really, really easy. Like I'd never approached things that way, but now I know that it's not easy.
It's not,
It's possible. It just takes work.
The thing is, it requires a degree of discipline that our education system has not designed us for anywhere in the world. It requires a personality that we are not built for, because it's very much around self-corrective behavior. And most humans are not self-corrective. It takes quite a bit of courage to be self-critical. We don't like admitting that we're wrong, even to ourselves. So when you trade and you make a mistake, most people try and just bin it into the corner and forget about it. But in trading, you've got to be honest with yourself and say, look, I screwed that one up. This is why I screwed it up. So you have to have something to reference, like I didn't do this and I didn't do that and I should have done that. And then you can correct that behavior. You can correct that action. Most people don't have the time, the effort, the energy, or the inclination to want to do it. So the ones who come in approaching trading as a quick one-off, let me try and do this, and they win. This is where it gets a problem. They win and they get lucky and they suddenly get rewarded for that bad behavior. And that bad behavior begets more bad behavior and it just snowballs. So this whole, watching Dogecoin go up like it is, it's just going to encourage more reckless speculation. And it's going to create more feelings of FOMO that make people go and do crazy stuff. And, I just think if people want to get good at trading, you have to put consistency above everything. It's the ability to generate profit after profit after profit, boringly. I mean, you've seen it. It's a lot of work. It's grind, but it's consistent. And once you start developing that degree of consistency, the enjoyment should come from the consistency, not the home run. If you watch baseball, you get excited when there's a home run, but not every batter gets up to the mound and hits, or I don't even know what they call it, the plate. He doesn't get up to the plate and hits a home run every time. He hits singles. Sometimes he strikes out. So I suppose the batting analogy would be you need your RBI to be high. You can't have it always at 100%. You're not hitting a home run every time you get up there, right? So most people don't want that. It's such an interesting thing to watch, though, because when I take on new clients and you ask them, what are your expectations? Their expectations are so far divorced from reality. And a lot of it's this advertising. It's the news. It's people telling you, oh, how easy it was. I was sitting at the beach doing pull-ups at Venice Beach and I made 40 grand on GameStop, and everyone thinks that's normal, but it's not. They don't interview the guys who lost their life savings on GameStop, and they don't interview the people who, have lost money, hand over fist year after year. Go and talk to those guys for a bit, but they're not newsworthy, those guys, So.
Well, I heard about something from a friend of mine about AMC. Another one of those things, like another short squeeze or something. So what do you think about this? Like, I was just kind of curious what you.
There's a way to play short squeezes, right? And we were in GameStop before it went through that manic period, right? So we had a plan. We attacked the short squeeze. We got some of the gain. We didn't get everything. I think I had one or two clients that held on to some of their options and they made quite a lot of money. But the average trader that we have had no interest, or we didn't have a plan that allowed us to capitalize on that short squeeze, because timing that exit is impossible. It's impossible. You don't know where the top is. And there's some poor guy out there who bought GameStop at $483. He's somewhere out there, okay? So when you play a short squeeze, when I play a short squeeze, I don't really want it to get into a situation where you've got this little war between the Redditors and the hedge funds. I don't really want to play it there, because it's incredibly difficult to time your exit. So you set your plan and you play it. If there's a short squeeze on things, I think hedge funds don't want to get their heads ripped off now. So I think there's a little bit of apprehension to the degree of influence that these Redditors can have. And if I was a hedge fund, and I think it was one of them one of them came out and said, okay, from now on, we're not going to go short anymore in the market, because I think they lost 30 or 40% with the whole GameStop thing. I don't personally like the idea of the shorts getting eliminated, because the shorts create liquidity. And that liquidity can create some degree of volatility, and that feeds us, right? I think short sellers do the market a service, particularly in uncovering companies that shouldn't be there. You know, they just shouldn't be there. You just imagine, here's Dodgy coin, right? There's absolutely nothing behind it. It's a joke meme, and yet it's worth $50 billion. Shouldn't that be shortable kind of thing? If you think of the logic, you would go, well, what's the value that it is? Or, you know, what's the value that it adds? Nothing. And look at companies. You know, GameStop by just fundamental analysis shouldn't exist. It's a dying business. It's like Blockbuster, you know, back in the day, right? You know, I think short sellers do a valuable thing. And, you know, it's not a moral issue. I don't think you can bring the short selling thing down to a morality question, because it shouldn't be. This is a question of, there's two sides to every story, and not every company that's listed deserves to be there. There's a New Jersey deli I was reading about. It has one branch. It sells bologna sandwiches or something. I don't know, prosciutto in a bun. It does something like $135,000 of sales. And I was reading somewhere, and I can't actually work out if it was a joke or not, but it was worth something like $100 million. Like this company, this little shop with
So
no branch.
is it publicly traded?
I think it's a listed company. I'm going to investigate and find out more, but that's the kind of ridiculousness that needs to stop, because you as a retail trader shouldn't be playing in those spaces. If I said to, you know, if I talk to retail guys, what I usually say to them is, look, unless you can understand balance sheets and income statements, trade ETFs. Just divorce yourself from the question of opinion. You know, we shouldn't really have an opinion on valuations of companies. I don't. I've been doing this for 20 years, and I stay out of it, because I think interpreting financial statements is actually it's more skillful than anything. You have to have a skill, and it's a practice skill. I find it incredibly boring. So if I'm going to trade, I'm going to be trading an ETF, or I'm going to be trading a sector. I'm going to trade an index. I'm going to trade things where my inability to read financial statements doesn't become my disadvantage. You know, so if I'm going to buy a stock, I'll rely on reliable sources of information that are going to tell me, you know, what the stock is all about, and then I will make my decision. But just going on it because some dude at the gym told me to do it, I don't know, man. I think you're playing with fire, and the more times you win, the closer you get to that one-off burn that's just going to wipe everything out. So
Definitely a lot of bad advice out there.
Oh man,
I got to wade through it. It's like I was talking to someone about how it used to be that we had too little information. You know, that information was a resource that we had, and now we have too much. You know, and so instead of like collecting information, it becomes, how do you filter out this bullshit from the real stuff?
This is that is the absolute crux, man. I going on Facebook, you know, if you touch one ad on Facebook that happens to be connected to something else, your flow of advertising that they send to you is now just all, you know, it's just all funneled through. And I go on sometimes and I touch it and I watch the video and I have a look and see what people are selling. And I shake my head and I go, these people, you know, they artificially inflate their returns in order to be able to, you know, show that they're better than this. And I go, you know what? Past returns mean absolutely nothing. You know, don't tell me what you did last week. I don't care what you did last week. You could have just been lucky. Tell me what you're going to do next week, and then let's judge you according to that. Because that's where the signal is. That's where the key is. If you can say to someone, you know what, out of 8,000 shares, similar to the process that we have, and it's not to toot our own horn, but you know, it's to say this is the process. We go through, we filter the market, we find 3 stocks, and you know what? Our win rate on our weekly process is 87%. And we go in and we use the file and we've done all our work and we've assessed all of our stocks. We go in, here's the trade, and we behave like snipers. We don't go in looking at our past results and say, okay, well, last week we did this. We don't care about last week. Last week was last week. What we look at is we look forward, and that looking forward part is never in the advertisements. So it's a hard thing to sell. Like, you can't really sell based on forward stuff. You can only give people an opportunity to try a process for themselves, and then they must decide for themselves if they want to stick with that process because it's winning or move on. The problem with too much information, though, is it does create a mindset of there is always something better. So even when you've got a winning system, you have to control yourself not to change what's working. If it's working, stick with it. Don't go and look for more, look for less. So this is something that we've been trying to do. Is like, I look at my database and I look at all of the systems that I have, and I have probably, 27, maybe 35, somewhere between 27 and 35 different things telling me what to do at any given time. The question is, how do you weight that? How do you say this one is more important than this one and this one? So we have our scorecard, we assess our trades, we have our weighting, and we try and score every opportunity equally. So it doesn't matter if it's Goldman Sachs versus Coca-Cola versus something else. It's always assessed on the same basis. And then you can come up to some degree of consistency that allows you to take 5 trades, and on an equal basis, you can tell, you know what, I have a better probability of winning over here than I am over here, regardless of bias or whatever. And I think that's the skill that takes the most amount of time, because you got to learn to trust yourself. It doesn't matter if you've done this for a week or 2 weeks or 6 months or 20 years. You've just got to be consistent. And once you've got 30 days of data where you've been religious in your rule following, you can tell, okay, that didn't work. Okay, well, I'm going to scrap that. For the next 30 days, I'm going to do it this way. And if you don't want to do real money, do it with paper. And until you've got a system that consistently delivers the result that you're looking for to achieve the end goal, which might be a dollar number or a percentage return or whatever, you've got to constantly refine it. And I think that's the hard part people don't understand, is that if you're not modifying and correcting the behavior that's causing you to go wrong, you're never going to be right, because you're just going to be like a hamster in a wheel. So, that's what I try and do with my clients, is understand what is it that's causing them to go wrong. And sometimes it's as simple as misinterpreting an entry signal. As simple as that. Adding in when you shouldn't be. Or selling a call option for a credit when the trend was the wrong way, right? Just small things like that can make the biggest difference. So, the information that's out there, most people think that winning in trading is just about the stock and the trade. It's not. It's about how you manage it.
Yeah, so, I really like the way you coach and sort of have it so that people can develop. You have the system and you teach the system, but you teach a process on how to build the system. It's kind of like, when I teach science at college level, and I try to tell people science isn't just a big bunch of numbers. It's a process, the scientific method. It's just the process of refinement over time. I think it's the same way. So I just wanted to let the viewers know, like, Chris has got a product coming out through Rogue called Alpha Hunters pretty soon. So and we're working out the details, and we're going to get that to you. So if you want to go over to rogueinvesting.com, the link in the description, and sign up for the mailing list, we'll let you know whenever that's available. But so I wanted to ask you a question, and this is something that came up in a conversation, and it's something that I am dealing with right now. Is I was assigned some stocks, and I'm still bringing the price down. So why don't we just talk about covered calls for a second?
Yeah.
That's kind of the gateway drug into options for investors. Don't you think?
I think it's almost like a level 2 gateway drug. It doesn't get you as hooked as naked puts. I think naked puts start. So when you got the assignment, it was probably from a put that you sold. So it could have been a spread or a.
It was a put credit. It was a credit spread, a put spread.
So usually what happens is we try to avoid the assignment on a put credit spread by just exiting the position beforehand. So when you've gone into a put credit spread and you've got risk of assignment, so the stock is trading below the short strike, what you need to do is exit before the assignment date, because the issue is not necessarily the assignment of the stock, it's the administration afterwards, because you've got all these time delays that the broker is going to have around clearing. Now, technically, if you did get assigned, what I say to my clients is just exercise the long put and get those shares out of your account, get your money back. And then whatever your max loss was originally at the beginning of the trade, that's what you would have had. You take the L and you move on. Now, let's imagine that didn't happen.
Like your knee, and you ended up with
now you've got
Chewy and some Lee stock.
Okay, so you've got these shares in your account. So there's one advantage to it, is that if you've got the shares, you've got a longer term sort of up cycle, right? So you can get your money back, but it will take some time. So patience is really important. Now, most of the people who peddle the naked put strategy as a beginner strategy say to people, don't worry about assignment. You'll just keep selling calls on those shares until you can reduce your break even, until the stock price recovers, and then you get it. And that's really good in theory. The problem is reversals. So you get assigned at say a price of 21, and the stock drops to say 17. And you look at your option chain and you go, you know what, if I sell the 21 call option for 3 months from now, I'm only going to get 10 cents a share. And let's say your greed thing kicks in, and your greed thing says, you know what, I want more. So you drop the strike from 21 and you go to 17. Remember, you bought the shares at 21. Okay. So now you're selling it at 17, and you go out 60 days and you say, you know what, I look at the graph and I see this thing just trending down. I don't think it's going to be at 17 in 60 days. I think it's going to be at 14 in 60 days. So I'm going to sell this one and I get 50 cents. Okay, so you're not getting enough credit to compensate you for the price differential between the price you were assigned at and where you are saying to someone, I'm committing to sell these shares to you. So you've locked in a loss. If those shares get assigned, you've locked in a loss. And you go on. And now you're happy because you got your 50 cents, right? That 50 cents, that sort of, you know, pennies for some degree of comfort, right? 60 days is an eternity in options, an eternity. So you're sitting along, and day 12, you going, oh, you know what? The stock has just been meandering along. I haven't had much theta decay on my trade. I haven't really got much price differential. Volatility stayed the same. So there's no real price difference on that call option that you've sold. Right? So there's no profit generating already. And all of a sudden, the company comes out with an announcement. They go, you know what? Apple have decided to buy us, and they're going to pay us $45 a share. And you've committed to sell your shares at 17 that you bought at 21. And 2 days later, or the next day, before you had an opportunity to exit that short call, stock goes to 45. You've locked in your loss. You're done. You've now lost twice on that trade. You lost on the assignment. Now you've lost on this assignment, right?
So you always have to set your strikes above your break even, or your
break even is the key. If you cannot get out of that trade at where you can't lose, then you shouldn't do the trade. That's number one. So number one, don't lose anything. That should be your first priority. And if it meant selling the 21 call 6 months out, at least you know you're not losing. That would be my first priority, is making sure that my strike price is above my break even. So if they don't know how to calculate break even, it's going to be your net purchase price minus the credits you've received, right? So if I received a $2 credit on the put and I got assigned at 21, my break even is 19. So I can't sell it for less than the 19. That's why selling at the money calls below your break even are dangerous, because reversals happen. And reversals on stock, particularly in sectors with high betas, got to be really careful, because that high beta tells you when the market starts to move up, this is going to move up faster than the market. So why would I want to be selling myself short? Why would I not be giving myself that gain upside? So covered calls work really well. All right. So the covered call type strategy that I like is when I use a thing called collars, right? So I use a long collar, because what I'll do is I'll buy an index. I'll let the index ride a trend. I will throw in a long put so I don't lose anything on the way down if there's a correction. And then I sell my call option a few ATRs above the market price, just a couple of weeks ahead, not too far out in time and not too far above the price. So if I do get assigned, I'm locking in my profit. If the stock falls down, I don't lose anything. And what you want to do is de-risk yourself on the way up. So long collars for me are just covered calls with a bit of protection. But covered calls by themselves are a very effective tool, provided you're using the right stock. I wouldn't do covered calls on highly volatile shares. I want to do covered calls on stocks that aren't going to be vulnerable to explosive moves to the upside. Consumer staple kind of shares, Colgate, Heinz, Kraft Heinz, Coke, McDonald's. Those are the kinds of things that you want to be aiming for your covered calls, because those stocks don't move in big movements. So selling calls against stocks that are prone to big explosive moves can leave you losing if you've gone underneath your break even. So I think it's a worthwhile strategy when the market tends to drift to the sideways. When the market is neutral to up, covered calls work really well. But if the market is neutral to down, no, I think they're better strategies to use, especially when you're buying shares, because you're sucking up a lot of capital to hold those.
Yeah, that's the one thing that I don't like about the assignment is the fact that I have these shares and like I could be using that capital somewhere else.
Well, there are ways to substitute the stock. So when we start using leaps, for example, and I wouldn't do this on stocks that are prone to big swings in value, or sentiment can start to shift. I would do this mainly on ETFs, where you buy a 2-year leap and you sell forward dated contracts on it. So let's say I buy a deep in the money call option on the SPY, but I sell out of the money closer in time call options for income. There's some technicalities that you have to do between, how the deltas work between those two and the IVs work between those two dates that you're using. But, using those kinds of calendars and diagonal strategies also makes sense. And they're just derivatives of the same concept. I own something and I sell a contract against that. So, getting assigned is probably the first thing you want to avoid. So if you want to avoid getting assigned, make sure that in your rules on bull put spreads, you never want to be holding them in a market. So this is a very key thing for anyone who's watching. If the market gets too extended, right? So if we're sitting in the sort of upper, 2-3 ATR from the mean type market scenario, and we're moving into a volatile season like earnings, you don't really want to be holding put spreads on stocks that could be prone to a pullback, particularly going into that week of expiry, because you don't want to be sitting with a 75% profit the week before expiry, being greedy, holding on to it just because you want that extra 10% for the weekend. Stock comes out with an announcement on the Sunday before earnings saying that they've, the finance director's been crooking the books and he's taking his mistress to some faraway island. Now the stock is worth $5. You had a strike of 30. You're in the trouble there. So to avoid that problem, what you do is always make sure that when you set up your put spread, your risk reward should be even. Like I personally don't like risking more than what I can make. So if I can only make $500 on the trade, I'm going to risk $500. So on a put spread, I try and go for a 1-for-1. I give myself a lot of time, 42 days. I'll sell it out 42 days, but I have no intention of holding it for 42 days. My intention is to close it within 14. So if I can get that 42 days down to 14, so around day number 28 to go, if I can be at around 50% profit, I'm happy to exit the trade. That's a low risk trade for me, is waiting for those 14 days, letting the momentum and the other technical readings of the charts move forward on the price, and then exiting the stock, taking a 50% gain and moving on. What happens with a lot of guys is their profit target expectations tend to be very unrealistic. So they tend to get greedy. It's like, I've got a bull put spread in and I want 100%. And you know what? The hardest part of earning in any option trade is the last 20 to 30%. So if you could get out of every single trade and book a winner on everything just by reducing your profit target by 10 to 15% and moving your money on and booking a win, you know, the difference between having a 100% win rate and an 80% win rate, and the difference in profitability is small. Just reduce it and go with the 80%, and then just get out early of the trade. Just, you know, rather have reduced expectations on profit, particularly based on market conditions. So, you know,
Where do you think?
Sorry.
Oh, I didn't mean to interrupt, but I was just kind of curious, just talking about market conditions. Like we're in a little bit of a pullback. Where do you see this market going?
Let's open up some charts. So, you know, this thing I mentioned to you, all the guys on my daily email and video a couple of days ago, that we were getting into this area on the SPY where things look, you know, here's the third Keltner channel. You know, we've been hitting the third Keltner channel since the 13th of the month. It's been a week and we've been drifting above it. And we need to understand that the natural order of things is for the market to pull back to the mean. So here's the mean, which is at 404, around 404. We have strong support at 407. We've got a resistance line at 417. I think we could pull back maybe down to 1 ATR. If we can pull back to 407, that's a buying opportunity. If we pull back even lower, even better. But this shouldn't be a surprise. You know, people tend to get completely surprised when they see the market dropping in price. This is not a surprise. Anyone who understands the market dynamic knows that this is what is going to happen. You get too extended and you're going to come back. And if you go too far to the downside, you're going to come back. And if we just drag this out a little bit, let me zoom out. I'm going to zoom out a bit. Yeah, if we zoom out a bit, apologies for all the lines, but if we zoom out a bit, you can see every time we get overextended to the downside, we move up. Every time we get extended to the upside, we move down. This is the natural repetitive cycle of things. So we got a little bit extended to the upside, we're going to come down a little bit. If we go back this way, you could see extension to the upside, we come down a little bit. Extension to the upside, we come down a little bit. That's how it works for every single asset. Every single asset has the same characteristic. So for now, you know, I wouldn't be surprised to see a little bit of price weakness. Now, we're seasonally in the strongest week of the month. So historically, if you go back over the last 20 years, this week is very, very bullish. It's a very bullish week. So individual days where we see a little bit of pullback shouldn't be a surprise. And we should take the opportunity to, you know, either buy in. But what you've got to look at now is what's going to be the sectors worth looking at going forward. Because if you're going to go and continue to buy, you know, high beta tech stocks, you know, and want to hold them over the summer, you better know that seasonally those stocks are strong, right? So when you start looking at the seasonality, simple thing here in stock charts, go into seasonality and enter your favorite share. Let's say it's Google, you know, and you just drag this out a little bit, give it, you know, over 10 years. What we see here is June is the worst month of the year for Google over the last 10 years. So you don't really want to be holding Google in June, you know, because 33% of the time it's actually raised itself up. So 67% of the time it will drop in June. So you don't want to be holding it then. So you've got to have this context. You know, everything is about context when you trade. So looking at where things are strong, you know, if we look at the triple NASDAQ, you know, May, June, July, this is the stock you want to be in, because seasonally over the last, let's see, 10 years, you have very strong May, a weak June, and then a great July. So somewhere around the middle of June, you want to be looking to get into, you know, the NASDAQ and then holding it for July and then getting out at the end of July. This is where it starts becoming really hard to plan, because you don't want to be doing positions that expire in June on that stock. You would ideally want them to be expiring in August. So you get this sort of rise. So everything comes down to this context. If your trading plan is I'm only going to buy Roku, well, you know what, you better know where Roku is going to be behaving. So Roku's only got a 5-year history, but look at Roku, June, July, August for the last 5 years, very, very strong. Can it continue? Like, these are when you have to go into the technicalities on the chart. Is it set up to be gaining in that period? And then you would do your trade. But you've got to be completely disciplined when it comes to this. You can't just go in and say, oh, well, let's look at, this guy because, this stock because my buddy at the gym told me to look at it. I have a watch list of stocks that I watch. And I find that over the summer months, trading more towards the ETFs of the strong sectors as opposed to the shares within the sectors tends to be better for me because I worry less. And, it's summer. I want to go and spend some time at the pool. I'm in Canada. I want to be skiing on the slopes. Okay. Apparently we're going to have snow this week. It's just bizarre.
Yeah, it's warming up here. I'm sort of doing the same thing. I'm sort of shifting over to the ETFs.
So what you should do is build a little chart. So here's my little chart of the ETFs of all the different sectors. I've got Bitcoin in there as well. And I try and watch it. I just want to see the market condition, whether it's above its EMAs, and how is the IV looking? Because if the IV is getting into this gray box, that means I can potentially do some put spreads. If it's low, it's going to be buying call options. And I just keep my eye on this, and I'm looking for synchronicity on where things line up. So what we have here on Ethereum, we have a very strong bullish case for Ethereum. Where we look at Bitcoin, we can see with Bitcoin over here, we've got, you see this change here in Bitcoin, the market condition has weakened a little bit over the last 2 days. And the trend is sideways, whereas Ethereum is bullish. So based on that, I want to be long Ethereum and I don't really want to be in Bitcoin. So yeah, you've just got to be, following some consistency in terms of how you analyze the market. Which are the sectors that I like at the moment? I like healthcare. So XLV, I really like this. I like the fact that the trend is starting to shift up. It's got to break through these lines. If we can get a close above 121.91, we've got some nice upside from there up to 123. Trending is up. So I think that we've got some opportunities here in healthcare. The other one that I like, I think we're coming to the tail end of XLC. We've been in XLC for some time. So I think we're coming to the tail end of this trend. So we may start looking to exit our position in XLC. XLK technology, we know that the NASDAQ will have a strong May, June, July, right? So its bad season starts towards the middle of summer. So I think I'm still in this one. Let's see. Utilities is where...
For XLK, would you recommend...
What type of trade?
Well, would you recommend getting into that now or waiting?
You can. One of the ways to look at XLK is to go through and look at the sector review here. So you can go into the sector summary here, go into XLK there. And if you click on it, you can actually see which are the subsectors that are worth looking at, right? So from here, the stock chart's technical rating here, you just want to pick the one with the highest number. So you go into electronic equipment, pick this up. Now, some of these companies are too small, so I like to look for the large ones. So, these would be the ones that I would be looking at, would be these bigger companies down here, the ones that are classified as large. And I want the ones that have got the strongest rating. So ZBRA, sorry, you guys say ZBRA. If we just put that in, ZBRA, let's see what this looks like. So I'll try to color code what I do here. So the more green I have, the better it looks. Man, I've got to fix this. I don't know why it keeps doing that. Oh man, you can see I haven't been on the mats for a while because my reflexes are like a mole. I haven't got my cat-like reflexes at the moment to stop my chart from going back to the beginning. There, right. Okay, so if we look at that, we can see it's not exactly in the buy zone. So for me, the buy zone is somewhere between this Keltner channel and this Keltner channel. Here's my buy zone, +1 to -1. But trending nicely. I like this trend. This squeeze looks a little bit, it's nice. It's to the upside, but we've already fired. So there's no compression going on here. We have a trending ADX. You know, this looks good. I mean, it looks good, but then if I compare it to XLK, you know, here's XLK. I would probably default into the ETF just out of safety's sake. I don't want to be sitting with any sort of single stock risk for a while. If we look at the trend here, oops. There. So if we look at that trend, you know, that's a pretty decent looking graph that you want to be playing, sort of this long game. So from here, you know, we can see it sort of going up. It's sort of at the top end of its forecasted range, price target of 144. We're at 142. Maybe not the time. Let's wait for a pullback on XLK if you're going to play it, unless you want to buy leaps. If you want to buy leaps, then, you know, timing isn't as important. So looking at XLK, you know, we've started to build positions over here already. We're up 42%. We've been in the trade since the 5th of the month, so for 2 weeks. But you could easily go out, you know, somewhere here. You know, I wouldn't take a 2-year view. I would probably go out, you know, there's our trade here. It's slightly out of the money. Go maybe up to 150 days, you know, do the 60 delta bull call spread. So 60, 40. So our 40 is, we'll take the 36. So 60, 36. And that's the 150. You know, looking at that, that's going to give you almost a 2-for-1. Oh, that's a 1-for-1 almost. You're going to put down 630, upside's 570. That's a pretty decent trade to look at if you're looking to just get maybe a 30 or 40%. But you can add it, right? So when you're doing these trades, you don't just do one and move on. You build, you know, my first trade here is a long call. Once this gets up to 100%, then I might take out half of my position and use that half to finance a bull call spread. So now I'm keeping the money in the trade, but I'm changing the dynamic of the trade. So I'm giving myself a little bit more upside and at no extra capital cost, because it's still the original amount that I put in. And we could use a, you know, a funding transaction possibly here on the bull put side. We could put a bull put spread on. Now's not the time to do it, but, you know, if you look at this, I've put in $500 into this trade. I've already made 237, so we're up 50%. If I could take that 237 and move it into a bull call spread for a different time frame, it's a free trade with upside. So I'm taking the profits from one trade, moving it into the same trade, but a different kind of setup. And that's how you can compound your money pretty quickly. I could move this into a long dated butterfly, you know, somewhere here at the expected move. So 726, that puts it around 150. So if I went with a 150 butterfly somewhere here, you know, for 24 days out, this is not a trade to do, but I'm just giving the example. 140, let's drop it down, 140, 150, 160. You know, something like that will cost me $279, which is pretty close to that amount of money, right? So if I could sell 3 of these, take the profit, buy this one, watch this, the upside that I'm going to get here is $721. So it cost me nothing, but now I can make another $700. And then if I make, let's say 400 there, I take the 400 and I buy another trade. Same stock, same trend. I just keep on building that position as we, sorry, the printer just turned on for some reason. So I apologize for the administrative noise that we have here. My son is on this online school thing. So, you know, he has to print these things out. But that's the logic behind how you can compound and take advantage of single trade, you know, graphs, but have multiple trades in it up to your allocation. You know, what you would do is go, okay, I can have 1% of my account exposed to XLK. And if that 1% of your account is, say, $1,000, this trade was only 500. So that's $500. So it's a 0.5% trade. If I take the profits from there and add it, I'm not adding any capital. I'm still way under my allocation, but now I've got 2 trades in. And so the first trade is financing the second trade, and it's with profits, etc.
Yeah, that makes sense. So I know we're in earnings season. Are there any earnings trades that you like?
I really like Goldman Sachs. I mean, we got into Goldman Sachs a couple of days ago. We got in with a long call on the 31st. That's done pretty well. Our combined trade is up around 150%. We put on a put spread just to finance this call option. So it became a 50% finance trade. So we only really used about $300 for this trade, and we've made around 500 already. So I like Goldman's. The thing with earnings is it's a crap shot. You have no idea. No one has any idea. No one knows if it's going to go up or down. Zero. So the way I like to trade earnings is I have a indicator that will tell me when I'm 10 days before earnings and 10 days after earnings. And I like to trade into the 10-day window, exit before earnings, let earnings happen. If earnings gap up, I'm going to trade a gap up and go. So maybe I'm going to do a long call or a put spread, depending on the setup or whatever it is. But I ideally don't want to hold anything into the announcement. So if the announcement is in the morning before the market opens, I get out the day before. If it's at the end of the day, I get out in the morning. I just don't like the idea. And I don't think anyone knows. So
it seems to be completely random. I mean, as far as what happens to the stocks after earnings.
I think what happens now is you could be, if your stock is overextended at the third Keltner and you go into earnings, it doesn't matter what number you have, people are going to sell off. It's just, I think a lot of times we have a setup now where the technology stocks that got whacked in February and March have certainly got an opportunity to be making higher highs prior to earnings. So if they make higher highs prior to earnings and they come out with any number, doesn't matter, it's going to be disappointing. You've seen these things where guys come out and say, we beat the numbers by 150% and the stock loses 20%. So I just don't like playing in those ponds. It's just not something that my nervous system likes to handle. So I'll just wait, let all of that stuff filter itself out, and then you carry on. And whether you want to, if you wanted to play the lottery around earnings, there are ways to do it that can be pretty nice if you can pin it, but it's hard. Your pinning success rate is going to be hard at earnings because you just don't know. So you could play both ways, right? You could do two butterflies on either side, on a put side and a credit and a call side. Like you could do that. We tend to do that more with the indexes. So you've seen how we do it. Sometimes when we've got this sort of indecision around where the market's going to go, I think we did it on NASDAQ about a week and a half ago, where we bought a butterfly on the one side for the upside, and we bought a put butterfly on the other side for the downside. And at the moment, the put butterfly is making enough money to compensate us for the loss we will take on the call butterfly. So you sometimes can trade both sides of the market and win. It doesn't matter. It's like taking a straddle. Often with straddles, for example, when we do a straddle at the money and you buy a call and a put at the same strike for the same expiry, sometimes what you'll find is the leverage, the delta on the one side is going to be higher than the delta on the other. So even with a straddle, there's a bias because of the delta differentials. So if I buy a call and a put and there's more delta on the call side, I really want the call to win. I'm just buying the put as an insurance trade. It's going to stop me losing as much if the stock drops, right? That's all. I'm still going to lose. I'm just not going to lose as much. So straddles become a very expensive trade because you're buying two options and you can lose on both. If the stock doesn't move definitively in either direction, those can both erode to zero. So what you want to trade,
straddles? I mean, what do you look for in a stock if you're going to do a straddle?
For a straddle, you sort of want the stock to be trending sort of a horizontal movement, but you need to see underlying pressure, the compression of the squeeze starting to form. So if I've got a stock that's choppy and I've got this compression that's forming, so the Bollingers are tightly compressed within the Keltners, I know that it's going to explode one way or the other. I just don't know the direction. Then you would do a straddle, and you would have to play either way. And the key thing to the straddle is exit the losing leg quickly. So if I can exit the losing leg at a 50% loss and maximize the winning leg and get a double or a triple, I will pay myself back for the loss on the losing leg and make a profit on the whole trade. So you've got to play, I think in options, you've got to play both sides. You can't trade options just bullish. You've got to trade neutral. You've got to trade bearish. You've got to trade bullish. You've got to trade bullish, then bearish. There's so many different permutations of how to set it up. But you've got to play to your strengths, right? And if your strengths are, I can tolerate loss and volatility, cool. With earnings, hold it over earnings. For me, at my age, and you can tell by all of the gray hair, my ability to tolerate volatility is rapidly decreasing. So I try and trade for consistency. I don't really care about those big hits. When we hit those big numbers, it happens. I don't get overly excited about it. I'm happy that we do it, and I'm happy that we get them. At least 20 to 30 times a year, we will have those trades, like the Google trade, or like our Adobe trade, or whatever it is. We'll get those because our process will filter those things out. We will find them through our process. We don't get them by luck. We get them by design. So when those opportunities are here, we take it. And then, you play it from there. And I prefer that kind of trading, putting in a bit of your allocation towards the long haul trend on the ETFs. And when you've got these opportunities where you can swing for the fences, you take them. That to me that's how you build consistency. You don't build consistency sitting in chat groups. It's never going to work.
YOLO everything you have on out of the money calls on random stocks and Reddit.
There's an interesting thing about out of the money calls, because if you go back and look at how we made that money on our Google trade, it was an out of the money call option. We made it on the out of money call option. So the way to do out of the money call options is always to understand the expected move. If you understand the expected move and you understand time and you understand the stock's seasonal performance or the seasonal behavior of that share, all right, so you have to know how that stock behaves when it's compressed and how it can explode to the upside. Buying an out of the money call is often the cheaper way of playing the upside. I mean, Amazon and Google, you do an at the money call option, you're going to be putting in, on $100,000 account, you're putting in like 10% of your money in that trade. It's going to be expensive, but you do an out of the money call option, understanding expected move and setting it up the right way. You don't have to put more than 1% and you still participate. You see, the thing is, even though your account may be small, you can still participate in these setups on these expensive trades as long as you set it up correctly. And that's a process. It's just, you've got to understand the process and be consistent. You don't need to, have other people do it for you. If you have a methodology that allows you to capitalize on a setup so you can weight it, score it, assess, unemotionally, I'm going to do the trade. This is the trade I'm going to do. It worked. Yay. Tick a box. If it didn't work, cross. Why? This. Okay. That's what you need. And then you land up consistent. You've seen the results that we get. I think our average for this year, or for the last sort of 27 weeks, is 3 times what our budget is. So the reason it's like that is because of the process. It's not because of, I'm not a stock picking guru at all. There are people out there that are much better than me, but my process works for me, and that's what makes it consistent. And that's my goal, is consistency.
Right. Well, I think you've definitely achieved that. So I like it. Well,
I wanted to make sure that I also basically have a shout out here for Sergio Pettis Gym in Las Vegas. Congrats on the win for Robert Whittaker this weekend. Great fight, the UFC. Did you watch it?
I didn't get to watch it live, but I'm gonna watch it.
So Sergio was there. He's Robert Whittaker's one of his coaches. So one of the best jiu-jitsu schools I know. So shout out to those guys.
Absolutely. Well, Chris, it's been great talking to you as always.
Thank you for the time, man.
If you guys want to just make sure you subscribe and head on over to rogueinvesting.com, sign up for Chris's newsletter, and get some more info and info about his upcoming product, Alpha Hunters. So, Chris, till next week.
Take it easy, my friend.
Man. Take care.
Cheers, buddy.